Joining me now is Ryan Dietrich of Shapers Investment Research. Ryan, share with us some of the statistics we've seen from previous Novembers and Decembers.
That's right. As we come into the end of the year here, November and December historically are pretty strong months. The last 20 years, those 2 months have been higher about 80% of the time, up almost about 6% of the time. So, you all talk about the Santa Claus rally, end of year rally. There's a good chance after the Dow is about flat for the year, we do think there's potential that seasonality can take over and maybe have a good end of year rally here.
Now, that's a very optimistic view, and of course, people who are looking at Europe might get a little nervous there. So what happens to those predictions if Europe doesn't shape up as well as we may expect?
Well, to us, it all comes down to expectations. And when we look at the stock market, we just think there's very lowered expectations. Look at this weekend, the Barron's Big Money Poll that came out. Expectations for the year end, the bulls are right about 12,000, right where we're trading right now. So to us, that's not very optimistic. Again, mutual fund outflows, a lot of people taking money out of the stock market. So to sum this up, with lowered expectations, we think, yes, if there's negative news out of Europe, of course, the market will go lower. But potentially a bigger risk is if there's any good news whatsoever, like what we saw in October with those lowered expectations, the market can go up much faster than it will go down, and the negative news will be our view.
And you said that you think that a lot of bullishness will be directed towards small caps and mid caps. We've seen more optimism towards large caps so far, so explain that shift there.
That's right. The last 10 years, the IWM small cap index is actually up about 71% versus a Dow return of about 12% the last 10 years. So for a while now, small caps have been leading. Again, back to that Barron's Big Money Poll, lots of optimism toward the big caps. To us, it just says with the economy slowly expanding, the small caps are really a canary in the coal mine, so to speak, in that when the U.S. economy does better, small caps do better because they don't really care so much about overall global. They're more domestic by nature. So the economy can turn around, the market can bounce. Small caps and mid caps have been leading us quietly really for 3 years now, 2 years since the March 9 lows, and again really the last 10 years. So as long as we keep seeing that negativity towards small caps and mid caps, we think those lowered expectations on rallies, those are the areas you want to play in. You don't want to play something everyone loves. You want to play something that people kind of look at maybe a little skeptically with that strong price action. That's small caps and mid caps here.
Great. So here's Ryan saying that small caps and mid caps will see more upside in November and December.